Hey, everybody, welcome to today's Coffee with Cramer, where we talk about real estate, lifestyle, and community. And I'm excited today because I've got a great friend and a great colleague, Jerry Wilson with CrossCountry Mortgage. Jerry's reaching us remotely from his office. And Jerry, how are you doing today?
Doing
Cheers.
great, Don, and certainly appreciate the invite for coffee with Cramer.
Appreciate what you got. What you got in the glass today, on the mug.
I just got a little French vanilla, a
Hmm.
little roast on there, a little mild. It's 11:30 here in Portland, Oregon, so nothing too powerful, but enough to get the day started.
Exactly. So, Jerry, we appreciate you being on, and I think we need to keep the coffee going because we need to stay alert. Uh, Jerry, a couple weeks ago, you and I we recorded an episode. I had a couple of, realtor trying to be video producer glitches. Welcome to the club. But in those 2 weeks, we've seen yet another shift as to what's going on. So, ladies and gentlemen, I've asked Jerry to come back today, and he had some time in his schedule. And we want to kind of bring people up to date because, as crazy as it is, it's June 1. We're almost at the mid year point, and a lot has taken place not just since the beginning of the year, but even over the last couple of weeks. And we want to bring everyone up to speed as to what we're seeing in the market space, what we're seeing with mortgages, and where we think things may be going over the next 30, 60, 90 days. So, Jerry,
Well,
welcome
Don,
back.
certainly appreciate the invite again, and you could say we've had a little glitch in the market the last couple of weeks because a lot has changed. On a positive note, the stock and equity market ended up positively for the first time in 9 weeks going into Memorial Weekend. So I always think that helps investors and potential buyers out there to rest assured that their investments have stabilized because it's been a rough couple of months. And we've also seen a little bit of fluctuation in the interest rate in a positive manner as well. And as you well know, Don, the 30-year fixed mortgage is based off a benchmark called the 10-year Treasury yield, which has been kind of hovering right around 3.0. And as of this morning, that's at 2.94. And so, kind of in layman's terms, Don, what that means, that puts interest rates right around about 5.3 to 5.5%, depending on credit score and down payment. So it's been a positive shift in our market on it. And Don, we have a lot of dialogue of kind of this year what's happening in the market. Again, it's a playbook that we haven't seen before. Interest rates earlier this year went up more rapidly than they have in 40 years. But again, when you're looking at a market that still interest rates in the low to mid 5.5% is still a great interest rate. As I mentioned before, my first house in 1989, that interest rate was 11%, and I was happy to get 11% interest rate, Don. So we're educating our clients that if you have a plan in place in 2022 and your plan is to buy a home, it's still a great time to buy a home.
That's a good way to put it, Jerry. I remember my place. A few years later, I think we had an 8% interest rate, and we're happy. And I think one of the big things, while we may see interest rates a little higher right now, uh, there may be the potential for a reduction in interest rates. I mean, the Federal Reserve and the bonds sort of price in where risk is at and where there's opportunity. And I think the big thing it looks like is the rate increases and the Treasury yield are factoring quite a few things, and one of them certainly seems to be inflation. The other piece is oil. Another piece is the war in the Ukraine and the unsettling that's having both in inflationary prices and oil, and then also too, will we see a cooling, a potential recession? It sounds like a lot of those are baked into the cake that we see right now with interest rates.
Well, and you're bringing up a really interesting point, Don. I had an opportunity with a small group of people to talk to the owner of Cross Country Mortgage. Our CEO is Ron Leonhardt, very talented guy and very in tune what's going on in the marketplace as he's managing 6,000 employees. He's already gearing up for a refinance boom in his prediction in the next 6 to 12 months. And what's going on in the marketplace right now, besides all those other factors that you talked about, Don? there's just a disruption in the back end in that secondary market. So after we close your loan, most likely that servicing of that loan is going to get sold. And so there's just a real disparity between buyers of sellers of mortgage-backed securities on what the value of these mortgages are worth, because a lot of investors don't want to pay a premium on closed loans if they think in 6 to 12 months rates are going to go back down and that particular loan is going to get refinanced and off their books, so to speak. So besides those factors that you're talking about, we're just in a really unusual market on the Wall Street level of mortgage-backed securities, of what they're worth and what investors are willing to pay. But we think the future is going to be bright. We think there's going to be a downturn, possibly in the economy a little bit, which generally means lower interest rates. So we still think still a great time to buy now, with the opportunity to maybe lowering your rate in 6 to 12 months.
So, Jerry, yeah, let's dig into that a little bit. And one of the things, so for people that are tuning into today, with Jerry, CrossCountry Mortgage is licensed in several states, including the state of Nevada. So we work with Jerry on quite a few buyers and investors and people looking for mortgage lending here in Las Vegas. Jerry happens to come by and visit, and we hope to have you here in office soon on your next trip down. But I just want to make sure that people know that we'd love to have Jerry come in remotely, but he's here periodically in Las Vegas to help with our clients as well. And at the end of the show, we'll definitely have Jerry's contact info available. Real quick, Jerry, so that's interesting. I made a little note here, and I want to circle back around on this refi boom, apparently. So one thing it seems like, too, is the last couple of years, because of the low interest rates, the bread and butter loan was the 20 down conventional fixed, because you could get tremendously great rates. There's a lot of incentives to lock in those low rates and get squared away. Now that's sort of tempered. Refinances apparently have tempered. Now what seems to be in play, though, is maybe some other mortgage products. I'd love for you to maybe talk about them and say, how do they compare to the conventional loans?
And thank you, Don. And it's very encouraging in that conversation with our owner. Not only do we talk about kind of what the market's going to look like in 6 to 12 months, but CrossCountry is rolling out a robust of products this month. We're coming out with a jumbo one-time construction loan close, which is really needed in the marketplace. We're seeing also a lot of non-QM products, which means non-qualified mortgage. So for clients that maybe traditional tax returns don't work in their benefit to help qualify, because if you think about it, Don, we have to go back to the last 2-year tax seasons that you filed for clients. So that would be 20 and 2021, which was a pandemic period. Well, most businesses, if you were self-employed, were impacted in some form or fashion with the pandemic on it. And so if those tax returns aren't able to get you qualified for a loan, many times we can use 12 months of business or personal bank statements and do a cash flow analysis off of those bank statements to help get our clients qualified. So we are seeing additional products that are coming out that are available for borrowers. And what that tells me is investors, Wall Street still are very positive on the outlook of what the real estate market is, because when you see additional loan products out there, it all comes down to what's the valuation of the collateral, and is that collateral stabilized, meaning is our real estate market still a healthy market? And that question is yes, or that answer is yes.
So you've got new products coming out, which may not meet your traditional, what we kind of always call the qualified mortgage, the Fannie and Freddie mortgage-backed securities, things of that nature, to non-qualified, but those are being marketed to investors or to groups, Wall Street or such, that may have an interest in providing these loans.
That's correct, Don. And in addition to those products they're coming out with, we're even coming out with fixed rate seconds and in-house HELOCs as well. So a lot of times we can take that conventional loan, add a HELOC on there or a fixed rate second on there to help get around the mortgage insurance premium, and also to get a little higher leverage opportunity to buy. But what that tells me is there's an appetite for those products, which means Wall Street thinks, hey, our market is still really healthy. So they're requiring less equity, or i.e. down payment, than previously required. So it's really encouraging to see these additional products coming out in our marketplace.
So that's good because it's giving people options. And I think I always like to say when I'm speaking with somebody is I look at a market as a series of headwinds and tailwinds. Uh, Headwinds are, what may be slowing things down, what may cause price adjustments, and then what are those tailwinds that are kind of boosting things that give excitement. And over the last couple of years, and even almost basically up until about December of this year, there were very few headwinds except for price appreciation because
Yeah.
you still had low interest rates, you still had a lot of cash on hand, you had a lot of strong equity position, and you also had so from a buy demand side, from a selling side, you were just building equity month over month over month, and two people were not quite sure what to do. But I think now that we may be reaching a point of cresting, the headwinds and tailwinds are a little different right now. So it looks like the headwinds now are okay. There's a little bit of fear of the economy, but
Yep.
the interest rates are higher than they were by a couple of percentage points. Uh, there, there's still lack of options, even though inventory is up. We've just put up now. We've just finally crossed the threshold in Las Vegas where we have more homes available for sale than under contract. That's the first time in 18 months, but we've only have a month and a half supply right now. So we're still building inventory. So we're a long way from being in a truly stabilized market. So and then we have uh, other headwinds like inflation being the biggest and pushing these costs down. But it sounds like the tailwinds are now the possibility of a little reduction in interest rates a little later in the year,
Yep.
new mortgage products, and still the big thing is a lot of cash still on hand.
Yeah, and I would add one other thing, and I think it's on a case by case basis, Don, that sellers are a little more open to negotiating, or a little more opening to accepting list offer prices as well on there. As you mentioned, inventory is up to 1.5 months. And I personally believe a healthy market is 4 to 6 months with inventory. But on the West Coast markets that we're seeing is sellers just a little more negotiable than they were 3 or 4 months ago.
So, Jerry, well, let's talk about sort of the summer season. And this is one other thought I've kind of had about this as well is when I'm seeing houses go on the market right now, when I'm seeing week over week as to the number of houses going into contract, while we're seeing still good movement, this is almost like we're kind of pre-pandemic. This is more like a
Yeah.
2018, 2019. It's summertime, graduations have taken place, or taking place, getting your house on the market for the summer season, either whether it's a downsize, upsize, you name it, and then people going on vacation. And we may see a little bit of a lull because people for the last couple of years have been cooped at home, or wanting to go and get out of town for a little while and then come back towards late July, early August to start thinking about that purchase again. And we may see like a slight dip in inventory again, kind of a more cyclic situation pre-pandemic. What's your thoughts on that?
Well, Don, you're spot on. Traditionally, this time of year is our busiest time of the year because schools are out and if families are thinking about relocating. They want to get it done in the summertime, get settled in before the school season starts. But I think you throw in the pandemic the last couple of years. I think there's a pin up demand for both buyers and sellers because if you've been in your house, you spent a lot of time there the last couple of years, and you may decide, hey, this is not my long-term house that I want to spend my time. So we think those sellers are getting their house ready for listing and putting them up on the market. And then certainly from the buyer's standpoint as well, some buyers just didn't want to take on the challenges that the pandemic provided in that buying process. And so now they're saying, hey, I'm starting to see rates go up a little bit. We're kind of getting back to normal. I think I'm going to take upon I don't want to say the challenge, but the opportunity to buy. And so we're seeing a whole group of buyers today that are getting their applications in, getting their pre-approvals done than we did see, for the last couple of years. So I'm in agreement. It's starting to feel like pre-pandemic, and it certainly feels good, Don, to be back to somewhat normal.
Yes, it actually is. While we're thinking about these questions and talking to people about this, I'm actually excited about the next several months being in real estate because we can have conversations, we can put together strategies to maximize, the purchase opportunity or maximize the sales opportunity versus, it was probably a little easier just to sign the ground, take orders, and there you have it because we had this convergence of unique circumstances. So, Jerry Wood, so when we look at this market here coming out, I want to kind of catch up with this refi boom because there's a lot of companies. We've heard several of the big national online brands laying off staffs, and your team's looking at a refi boom. Tell me a little bit more about that.
Well, and feel grateful. We're owned by one gentleman, single shareholder owner. So when you're not a publicly traded company, you don't have partners, you can make decisions on your own. But one of the challenges we've had over the last couple of years with just the incredible amount of loan volume is just finding really good talent and people that are experienced. And I'm talking from not only underwriters, Don, I'm talking docs and funders, I'm talking the compliance department on there. So uh, our owners just taken position. I've already got the team in place, and it's pretty much been record volume the last couple of years. So he was smart on putting his money away, and so he'd rather just keep the team that's in place. So when the opportunity in the market shifts in favor of another refinance boom, we're already in place to take advantage of those opportunities where some of the competition are laying off. So certainly, it was exciting to hear that news and feel blessed that CrossCountry is taking that position.
That's terrific. So it sounds like you're going to, and in addition to that staffing, there seems to be maybe an indication of potential refis, maybe as the interest rate ticks down a little bit from the high. What's to people out there that are tuning in? What's sort of a good separation or a good rule of thumb to say when you should refi based on your loan?
It's a great question, Don. And generally, the rule of thumb is interest rates have been lowered 1% from your current rate. You certainly want to reach out to your loan officer and have them run a estimate or a model for you to see if it makes sense. And then, so and we're always active with our clients as well. And we have a CRM system that if their rate lowers a point, then I'm reaching out to them. And then the second part of that equation, Don, is once we run the numbers, we generally want to see that the cost of the refinance or the savings, so to speak, pays for itself within the first 36 months or 3 years. But sometimes that mindset could change a little bit. If they say, hey, Jerry, I'm going to be in this house the next 10 or 15 years. I don't mind if my break even on my refinance cost is 4.5 years. But to answer your question, we generally like to lower the interest rate by a minimum of 1%.
So if we're looking at now, let's say we're in the low fives, interest rates tick back down to the low fours over the next, let's maybe call it 12 to 24 months. That's a great opportunity to say, okay, hey, I've got into the house I wanted. I've been able to enjoy it, especially if I sold my previous house and banked a lot out of it. And then now I'm able to readjust my cash flow with a refi.
Yeah, and just some real rough numbers, Don. On that example, from a 5.25 to 4.25 on a $500,000 loan amount would roughly lower that payment $300 a month. And keep in mind, those are after-tax dollars, so that's really a savings of $500 to $600 on someone's income. So yeah, it's pretty substantial if we can lower 1% on their current rate.
That's good to know. So, again, it should be about right now conversations and strategy instead of just buyer seller's market, because I think we have this opportunity again to sell high, put together a plan to buy right, because like you said too, I'm writing offers that are at list price. Now, yes, there are some I'm getting beaten out on, but we have quite a few now where we're not competing against multiple offers. So, and we also may even see some price reductions, which we're seeing a lot more of than we've had in the last 2 years. So, Jerry, I appreciate you being on today. If people want to reach out to you, how is it best to contact you?
Best way to do it is go to jwgroup.com or call me directly at 503-312-3332.
Fantastic. Well, Jerry, I appreciate you being on, and I know we kind of talked about possibly being in town soon. And again, with this shifting market, I may have you come back on. Hopefully, after we've got this one published in the next 24 to 48 hours.
I would love to, Don, and I think it'd be a great opportunity at the worst case that we do this in September to see how the summer buying season went
Yep.
and see how close we were kind of on our predictions and our forecasts. So would love to have the opportunity again.
Absolutely. And ladies and gentlemen, for those tuning in today, I'll put Jerry's contact information down in the description of today's video. And if you've liked today's video and want to learn more about what's going on with mortgage rates, the Las Vegas housing market, the broader housing market in general, and also living in, as my good friend John Curtis always loves to says, our humble little burg of Las Vegas, do us a big favor, hit the subscribe button and ring the bell so that way you can receive our latest videos, because here at the Cramer Group at Urban Nest Realty, we're about real estate, lifestyle, and community. Well, Jerry, we appreciate you tuning in and coming in from Portland, Oregon for today's Coffee with Cramer. Cheers to you.
Cheers, Don, and thank you so much.
Fantastic. And I'm wishing everyone a great day. Till next time, take care. Bye-bye.
Bye-bye.